Welcome to Smith Weekly Discussions, an occasional program for our readers and listeners of Smith Weekly Research. Please note this program is a private discussion and everything contained herein is for entertainment and educational purposes only. With that, we hope you're in a comfortable position, along with your favorite beverage, to enjoy the discussion. Before we get into our discussion today, we want to say thanks for questions coming from our audience at Smith Weekly, including Brian L., Eric H., at Feeds Explorers, Gordon S., and Mike P. Our guest today is Mark Chalmers, President and CEO of Energy Fuels, the dominant U.S.-focused publicly listed uranium producer. The company is listed on the New York Stock Exchange under the symbol UU, and on the Toronto Stock Exchange under the symbol EFR. Energy Fuels also has listed warrants on both exchanges. Mark, welcome back.
Good to be back, Andrew.
So, Mark, you just got back from Washington, D.C. What have you been up to?
Well, the company is really, deeply involved with our Section 232 petition that we filed in January of 2018. So I can't get into, actual details, but, we're certainly on the ground a substantial amount of time now. Talking to various parties with regard to the petition. And for those that are not aware, that was a petition that our co-petitioner was UR Energy and Energy Fuels, both based out of Denver, that filed the petition on behalf of the Section 232, which is basically a law that says that, that the President of the United States has executive powers to deal with certain, particularly, focused on commodities or other industries that have national security significance, and he has the ability to act on that behalf with his executive powers.
So where are we at with Section 232, and what is the timeline you see occurring over say the next 6 months or even for the rest of the year?
Yeah, well, it was initiated in July of 18, and that started a time clock with the Department of Commerce, and they had 270 days to put together a report that for a recommendation to the president on whether they believe that the petition that was submitted does have national security ramifications or not. Initially, we thought that might potentially be delayed by the government shutdown, but we believe that that's not going to be the case now. Now, I'm not saying that we can say that in absolutes, but right now the report is supposed to be prepared April 14th. So that's not a long time away. That's 6 weeks away. And we believe the Department of Commerce will submit the report to the president. The president then has a maximum of 90 days to either take on the recommendations, say no, or come up with something else. And the 90 days on that would expire on July 13th of 2019. So we're really on a very tight time frame right now.
So, Mark, if that comes out on time, what are the chances of the Department of Commerce putting out something publicly in April for people maybe to get their hands on and take a look at? Do you see that happening, or will this report go sealed to the president?
I'm not, Andrew. I'm not really entirely clear on what will be made public or not. I'll actually have to get some more information on that, but as I said, I do believe that the Commerce will finish the report in April. And in the case of steel and aluminum, he, made a decision. It was like 9 or 10 days after he received the report. So, it can all be a bit fast and furious, coming up in the next couple months. So, but I'm not sure exactly to what level of detail there will be released to the public. I think that certainly once the report is in the president's hand, people will know that, but I'm not sure what all the detail what detail will be released.
Right. So, Mark, you've got a number of relations with the U.S. utilities. Can you give us a flavor of what the morale is like there? And do you feel that there's any hard feelings about Section 232 action, or do you think some of them actually understand the situation and know why you're doing it?
Well, look, I think people kind of, there are a number of feelings about this. I mean, our focus is national security, and the United States of America consumes 1/3 of the world's uranium per year. We are the largest consumer by a country mile, and that's a big issue when you're only producing less than 1% of our nation's requirements. And so we're very committed that this is a national security issue. I think the utilities, and certainly we understand that there are customers, and we have long-term relationships with our customers. So this is by no means intended to cause them harm. But we think we're hurting more than the utilities. I mean, the utilities still, in many cases are making, multi-billion dollars a year in profits. And this is a small piece of their cost structures. But no, there are some people that have some hard feelings about this. But we believe the U.S. needs a uranium industry. Some people say, well, hey, we'll just get it from our allies. But our allies are hurting as well too. Look at Canada has cut down their production by 50% in the last year. And the only reason production is continuing in Canada is because there's long-term contracts that are supporting that production. If there's nothing is done with, or nothing happens to uranium prices over the next 3 or 4 years, I think the production in Canada could actually go to zero if there is no improvement in prices if those contracts expire. So I don't know all the details on what the contract structures are, but whether it be Canada or Australia, our allies are hurting. So with 232, we can't fall back on the allies.
Right, and from a national security standpoint, it's completely obvious. I think everybody's on the same side of the boat on that one. And with places like Canada, Australia, Namibia, none of these folks are happy at these prices, and it's not sustainable. And so I think it's a good piece that's going on, and the whole sector needs some kind of a situation, whether it's higher prices or something better, to get us above and beyond where we are today, and to kind of jumpstart the industry again. So you're absolutely right.
But I also want to say, Andrew, that with certainly, we've got, in addition to our relationships with utilities, we've got long-term relationships with our producers in Canada and Australia, and we just believe that if ever there was a reason for a Section 232 petition, that this one is ideally suited for the Section 232 petition. So sometimes the squeaky wheel's got to, we'll get the grease, and so we're doing everything we can to communicate that to the administration, and when we're getting what we believe is a solid hearing. They're hearing what we're saying, and they're hearing what the utilities are saying as well too. But they ultimately will make the decision. It's not going to be me, not going to be the utilities. It will be the government make the decision on what outcome, if any, will happen because of the petition.
So if we have some sort of positive outcome, give the audience an outline of the sequence at Energy Fuels. What's the plan if there is a positive outcome and a quota is put in place? Give us kind of the timeline and the sequence that you would go after to take advantage. Yeah.
Well, look, I can't get into all the details, but like you indicated, we're asking for a 25% quota of U.S. domestically produced uranium. Naturally, if you decided, or if the government decided that was going to be put in place at some level, it will take some time to ramp up or re-ramp up some of the production in the United States. That's still work in progress on how that would happen and how the whole mechanism would work. We're also pushing for buy American uranium. The Department of Defense basically has to buy U.S. uranium for their requirements. So look, there's a lot of moving parts here, Andrew. And as I said, I can't go into complete detail, but the concept is that we need long-term contracts that provide the certainty and the long enough time horizons so that investments can be made into the sector here in the U.S. And that those investments will be at a level or that those incentives will be at a level and long enough term to justify the investment. So, you can't continue to have the uncertainty. This can't be done like on a spot market type basis. This needs to be done with contracts.
So, Mark, is there a setup to where if there was a positive outcome, is there already lines of communication already opened up to some potential utilities at this point, or would it be a phone call from Energy Fuels to the utilities, or are the utilities going to call Energy Fuels and say, hey, we want to buy some from you, let's get into a long-term contract? Or is that kind of the first step before there's any action done on the ground at the projects, at the mill?
Look, it's really in the hands of the Department of Commerce at this point in time. I mean, there are some dialogues that are occurring at different levels, with different organizations. But we have to be very careful here because of antitrust issues, and so most of the dialogues are occurring through the government. So, as I said, I can't get into, all the details, but there are some discussions occurring, but most of that's focused on the Department of Commerce.
Okay, so what about a no action outcome? From a high level, that pretty much is finishing off the lame horse that's already down in the United States, the fuel cycle going away, the domestic production going away. If there was a no action outcome, what would then be the focus for the company?
Well, I mean, if there's no action outcome, I think the fundamentals for the uranium industry as a whole are still sound. I think that, you got increasing demand and you've got reducing production. So I think things are settling out, on the world front there. Certainly that would add another element, a time element, which would be unfortunate. But for our company, we've got a different placement than our peers, because we have these other sources of revenue, which are significant, but still not what we're trying to build the company around. We're first and foremost a uranium producing company. But for our case, we'll continue to push vanadium production, which we're currently producing high grade vanadium right now. We've made a couple of releases on that front. And that's a nice little sweet spot for us in the interim. So we will push on. If it's a no-go outcome, we wait for higher uranium prices, and in the short term, we'll be producing vanadium. We'll be pushing our alternate feed business, and we'll be pushing land cleanup to generate revenues into the company until prices justify going back in the uranium business.
Okay, on the vanadium side, that you brought that up. How are things going there as far as production, and are there any sales at this point?
It's going very well. We started up at the end of 2018. We're still ramping up, with the target being 200,000 to 225,000 pounds per month. We haven't sold any vanadium yet, but we think we're very close to selling it very soon. So we see that kicking in, very, very imminently, in very short term. The prices for vanadium went all the way up to nearly $30 a pound, and then just around the first of the year, they went down to 13. They're up to about $13 or $17 a pound. So we think the market will be strong for the next year or two. It's a very volatile metal, so you have to kind of capture the opportunity when it presents. So we're pleased where we are. We were cautious because the way we're recovering this vanadium currently from our tailing solutions, we had to do some different things because we were bringing it back into the plant at very lower temperatures, and it had it was basically pretty well aged because it had been out there in the ponds for a number of years, and we wanted to be cautious that we didn't sell vanadium basically ahead of when it was produced, and making sure it met the quality specifications that we needed to sell it. So, we're very comfortable that we've de-risked this thing technically, and now we're ready to start selling product.
So, Mark, where are we at on all-in sustaining costs on the vanadium production now that you're wrapping up? What can you give us a figure?
Well, no, not yet, but that's another element that we're looking at in the cost. We initiated our focus on restarting vanadium production when the prices were, probably $10, $12, $13 per pound. We felt we had decent margins at those levels. So now the price is up at $17 a pound. I can say we're not unhappy with $17, $18 per pound right now. So there are some, we think, robust margins, but we want to run this plant a bit longer before we go to the market and say what our costs are.
Okay, let's move on to toll milling. I know there's been some questions on that come in here. Is there any progress on toll milling contracts? And are you still of the opinion that Energy Fuels within their own projects can bring enough feed to keep the operation at full capacity right out of the gate?
Well, look, the White Mesa mill, actually, I don't think it's ever been at full capacity, toll milling or not. We've taken a little different tact with the mill. And at this point in time and leading up to Section 232, we have, not entertained any toll milling agreements. We have taken the approach that if people want line of sight into the mill, that we'll consider it on a joint venture basis. And that's for a number of reasons, but one of the reasons for the joint venture is that it's a very sensitive environment out there now for mining uranium, vanadium ores, particularly in Colorado, and we need to make sure that we are able to do that with all the permits required and with the extreme scrutiny that's placed on these mines today, much more so than it would have been 5-10 years ago. So our focus now is if people have good mines that they would like to put in production, we will look and consider a joint venture. So now, does that mean that at some later date, if somebody shows up with 50,000 tons of ore, 100,000 tons of ore that they want us to mill, would we mill it? And we might very well do so, but people will be doing that at their own risk right now without a milling agreement. So joint venture, we think, is a more prudent way to go at this time. But we also have some other things that we believe are on our doorstep that we didn't have in the past. For example, if we did some of this land cleanup on the Navajo Nation or some of these other abandoned uranium mines, that we can potentially fill the mill up with that type of material, and then we don't need to do toll milling or even joint venturing people's ores in the future. So we've got other options up our sleeve in terms of keeping that mill running at a high utilization level.
Right, and with the current prices, I don't see that there would be a lot of motivation. And if let's just use a scenario, if we're post Section 232, but uranium prices are still sub 30, do you really think that anybody would be knocking on the door trying to get an agreement at these prices?
Well, it's very risky, anyways. To start the mill up on conventional ores, we need 50 to 100,000 tons, probably preferably 100,000 plus. That's a lot of mining before we start up the mill. The the main thing that 232 would do for plateau ores is it would allow us to hopefully get some long-term contracts, which would underpin at least the price of the uranium in those ores, giving us sort of the line of sight that we're going to have uranium sales for, you know, several years, and that takes a lot of the risk out of it. You know, if you have low uranium prices and you have very volatile vanadium prices, it's kind of like playing roulette. And but if you can underpin the uranium prices, it's a lot less risky. So the uranium prices probably, you know, underpin 60-70% of the cost of mining and milling the ores, and so then you only have that, you know, say 30%, 35% that's open to the market, which would basically be the volatility of the vanadium market.
Okay, well, Mark, I want to twist your arm just a little bit more on this subject on the toll milling. If the price of uranium was at $50 to $60 a pound, what would Energy Fuels be basically looking at toll milling agreements at that price level, given the projects, given the production, given the situation that the company is in? And with that, I'm assuming that the fees would be much higher at that price level, and also more attractive for the company as well. Is that correct?
Well, I still going to drive you back to our objective is joint ventures. You know, we may do something different, but we might not. You know, the problem with the toll milling agreements is we don't want to, you know, basically commit to giving away, you know, space in the mill unless we have, you know, well, you know, some scratch in the game. Now, granted, we can get fees. I mean, historically, the toll milling agreements, very limited amounts of ore were what was actually processed under the toll milling agreements, very small quantities. So it didn't really have a material impact to the economics of the mill. You know, we might buy some people's ore potentially. But I just don't want to commit to exactly what we're going to do. If somebody wants line of sight with you know, line of sight to the mill, at this point in time, we're talking joint ventures.
Okay, and can you share with us historically what the fee has been, if you can share that with us, just looking from historic agreements?
You know, I don't. I mean, for the toll milling agreements, look, with the toll milling agreements, usually the fees were pretty onerous, and honestly, I don't think they're very favorable to those that were trying to make money off of those agreements. The advantage of a joint venture is we can give better cost structures that probably ultimately come out to be a better arrangement for you know, whoever partners with us than these toll milling agreements. Historically, a lot of people would get a toll milling agreement, and they would just go out and promote that they have line of sight to the White Mesa Mill, but they didn't ever fill that. So, you know, by giving out a toll milling agreement, a lot of times you're just giving people a free kick by having a document that says they can mill it, and the economics don't always play into the realities.
Yeah, exactly. So I want to move on. Future capital needs. Do you see that Energy Fuels will be offering up at some point, maybe in the near term, say the next 18 months, private placements or rights offerings to raise additional capital going forward? Or do you see at this point that the company is pretty much going to be self-sustaining moving forward?
Well, depends on a lot of factors. But
right.
Look at, I mean, we're gonna try to you know, bridge yourself, as I said earlier, mainly with vanadium in the first instance, maybe some alternate feed. We you know, we're still building up inventory. I think we have, you know, we're getting, you know, somewhere in the order of near 400,000 pounds of uranium inventory. If the price of uranium goes up, or you get some relief under 232 or whatever, that could be quite valuable. You know, will we go back to the market at some stage? I'd say it's probably likely. When, where, how much is yet to be determined. You know, we're not really planning to go to the market anytime in the near term. We've got Andrew, as you know, we've got a really strong balance sheet. probably leading balance sheet in our peer group, and so we're feeling pretty comfortable with that. But at the same time, the market can change, and that may change our direction. To restart all our mines, we're going to need a fair amount of working capital. Now a lot of that working capital kind of returns to you once you get things going, but so that may put us in a position we need to raise some funds. But on the other hand, if we have enough inventory, we may go out to some shorter term debt instrument to just basically float us for a couple of years while we're getting the cash flow reestablished, line of credit, or we can pledge inventory, whatever. So we're very comfortable that we're in a strong position to restart, in terms of timing, in terms of quantities, in terms of our ability to get the money we need to go forward at whatever speed we decide to go at.
So with back onto on money issues, capital issues, are offtake agreements in the cards at this point? Would that be something the company would consider if the right opportunity came along?
Yeah, no, I think we could, we'll consider offtake. It all boils down to, what does it all roll up to in terms of, the commercial aspects.
Okay. And on equity, private placements, entitlement offers, rights offers, what's your take on these kind of different methods of equity deals? Do you like one over the other?
Well, we actually like the ATM. We think that the ATMs are becoming more commonly used. When you start looking at some of these more traditional capital raises, they can crush the stock, and I won't name names, but you can look at a few companies where they've crushed the stock, including Energy Fuels. About 2 years ago, we crushed the stock on a traditional capital raise. So we found the ATM to be very effective. We rarely use it, but when the conditions are right, you can turn it on, you can turn it off for a short period of time. It's quite effective, and you don't crush the stock on it if you use the ATM responsibly, and the fees are much less. So we personally think the ATM is becoming a more important a means of raising capital, particularly when you have the liquidity and the interest in the shares.
Yeah, I think that has some components to it that are attractive, and for me, for speaking a little bit for the retail side, I know that entitlement offers, rights offerings, can really give folks that otherwise wouldn't be able to participate the option to come in and they're already a shareholder, and then they can exercise rights or entitlements to get additional shares. So I think that method, when priced properly, as you suggested, can make some sense to get the whole kind of group involved. So
yeah, no, look at that, Andrew. I think you got to look at all these things, based on the circumstances. And, but, first and foremost, we want to take care of our shareholders, and we have to, that's what we're in business for. They're the people that have invested in the company. So, ultimately we want, like last year, we had, a really good year, in a down market. Most of the market was down, but we were up around 50%. We paid down debt. The market rewarded us for paying down debt. The market rewarded us to having a strong balance sheet. And we were rewarded with the share price. So, I think I've told you this before, but I've been in this business for over 40 years. I spent about half my career in Australia. I've worked for some very talented people in this business when it comes to some of the biggest, most successful entrepreneurs. And I'm looking at Energy Fuels. I want Energy Fuels to be number one this year, last year, this year, going forward, because of the the vehicle that it is. And I wouldn't have come back from Australia to run this entity if I didn't think this was the best entity out there. Or if it isn't the best, and I think it is the best, it's the second best. So we're well positioned, and we are really energized going forward.
Yeah, certainly. And the company is in a very interesting, unique position, in my view, especially from the perspective of the U.S. It'll be interesting to see what happens going forward. So on that note, just a little bit, is the company looking at any assets in the U.S. or even globally that would be worthy of acquisition at this point? Is there anything on the acquisition front within the U.S. that you're looking at?
Look, other than maybe some joint ventures, which could be of interest, I think that if we get some relief, material relief under 232, I will look for assets outside the United States, because I think that having a larger cash flow and some profitability, hopefully, that's going to put us in a stronger position to acquire potential properties outside of the United States, particularly those that have negative cash flows and they're tired of diluting shareholders or adding those cash burns onto various financial instruments on the back, adding to debt to the company. So I think that my preference is to probably go offshore, with the exception of, as I said, a few laser beam joint ventures.
So Mark, what's on the schedule for the company in 2019?
Well, as I said, we're 232's right at the doorstep here. The clock is ticking on that. Focusing on the vanadium, pushing that as hard as we can. We're still accumulating alternate feed. We're not actually got it in the plan for the year, but that could change. We're still putting out proposals for alternate feed that can be fairly significant to us over time. We're still pushing Navajo, so we're busy. But we're also looking at putting some money into a number of our assets for what we call uranium readiness. So there are some investments that we're planning to make probably mid to late year in our uranium assets, with or without Section 232. This is things like drilling down at Alta Mesa. We're still doing some of the test mining for vanadium in the conventional mines at La Salle were opened up. So we're busy. We've got a lot of things going, but it all kind of is driven. We want to maintain that strong balance sheet. We don't want to draw it down too much, and so we want to spend our money wisely.
Well, Mark, anything else you want to add for the audience?
No, Andrew, it's just always good to have a chat with you, and look forward to reporting back next time you want to have me on.
Absolutely. Likewise. Thanks for coming on.
Thank you, Andrew. My pleasure.